I follow the real estate industry news every week, and this week I discovered news articles being prepared by Zillow. It's so bad that even Zillow doesn't want them on their website. They want everybody else to run them to create traffic for them, but even they don't believe the nonsense that they're putting out there. I'm Bill Gross, I'm a real estate broker in LA. This is my real estate market update I do every week, and we analyze the real estate industry news. I'll go through the details of the market. We'll get to Zillow just a little bit. As always, I want to do a quick recap on where the market is so we can make sure we're prepared to handle the market the best way possible. Mortgage rates this week closed at a low 6.35%. This is the low for the month of March, down from a high of about 7.1%, so almost 0.75% drop. With all the news and volatility about the banking industry, one place that seems safe even still are U.S. guaranteed mortgage bonds, which include mortgage bonds. And while Bitcoin's gone up and some other things have gone up and some have gone down, it seems that whenever there's problems in America or in the overall economy, the market wants more U.S. guaranteed bonds. And at this point, it looks like that includes mortgage rates. So how is the overall inventory? And I watch this really closely every single week. If you watch this program, you'll see I watch it every single week because I think those are the two things: the mortgage rates and the inventory determine the market. Buyers on the mortgage rates, sellers on the inventory. And inventory continues to be tight by historical standards. You'll see here again we're tied for last year's number, but we're still below. And it's higher than the year before. I'm sorry, we're tied with 2 years ago. We're above last year's number. Right? So they say, well, inventory is higher than last year by 30%. That's true. But look how much lower it is than the historical standard. And so all this means is that we still are correcting. In fact, I think if there's one way you could summarize the real estate market today is after the 2 years of the pandemic, like almost everything in our lives, we're still slowly but getting back to a normal market. And so the abnormal factors of the last few years are being replaced by the more normal factors of the last few years. Let's take a look in Los Angeles specifically, where I'm located. And the market is a seller's market ranking of 40 out of versus last month's 41, according to Altos Research. And most of the indicators are tracking pretty much flat, or if anything, inventory is still tight. So the market overall is about staying where it is, with all the volatility in certain areas: Boise, Austin, Phoenix, Southern California, and most markets nationally are pretty normal right now. This is a normal real estate market. Another way to look at inventory is on a historical standard. I saw an interesting article by Redfin this week, and they talked about how, again, the inventory is much higher than the last year. But their own, and this is, oops, I just lost the spot there. I hit the wrong button. I'm so sorry. And I'm not going to stop recording this. What I want to say is that inventory is still higher than the last 2 years, for sure. But look what it's compared to prior years. This would be the record all time in any other year. These are years with less people, and we had more homes for sale. How can that be? And the answer is that we're still in a very tight inventory, loosening a bit, adjusting back towards normal, but still not at a normal level. Oh, there we are. I'm sorry, there's the graph. So this is where we are now, and Redfin does point out correctly, the inventory is higher than the last 2 years, significantly so. But look where it is overall historically. It is the lowest by far ever. And so I think, again, all you can really say is the market is returning to a more normal market. I think that news people are desperately looking for a glimmer of information to say things are changing. For example, John Lansner, who's a writer for the Orange County Register, posted a Twitter, I think it became an article, on how the median house prices have dropped significantly. Well, that's true, but again, look at the time period. This is 2019. Look where housing prices were. And so we're still dramatically higher than we were, at 735, dramatically higher than we were 2 years ago, 3 years ago. We're on a normal trajectory. We're nowhere near where we were before the last housing crash. We have a long ways to go for that to happen. This would be what we consider a normal market. The other thing about this is very misleading when you see stats on the average sales price or median sales price. It's true that the high end has dramatically slowed down. There were a bunch of millionaires and billionaires who bought a lot of houses in COVID, and they've stopped buying second, third, fourth, fifth, eighth houses. As a result, the sales units at the high end have dropped tremendously, and it's bringing the average price down. But at the average price points, those houses are still not dropping in price, just the number of sales. There's a big distinction. One of the things that made me smile this week was I saw the release from the Mortgage Bankers Association, and they put out their predictions all the time on housing starts, housing sales, and then interest rates. They project interest rates this year. They project them to be 5.3%. We're at 6.35 now. And they're saying next year they'll go down to 4%. I think the thing that I find funny is this didn't really make much news. So it's either the mortgage bankers now has been thoroughly discredited as a source, that nobody wants to bother quoting them, or it could be that their predictions aren't outlandish enough to make the news. I don't know which it is, but either way, there was a time when a new release was major news in our industry, and now it just does not even get covered at all. A very interesting graph was I found from Fortune magazine. There they tracked the appreciation in the housing market by decade, and what it showed is almost every decade ended up about 400 to 500% higher home prices than before. Here's the 90s, the 10s, the aughts, the 20s. And here we are in this, the 2020s we're at now. We've already hit that level, which might mean that and this is, I think has happened, we ran up so much so quickly that we're going to be more flat for the rest of the decade, or flatter by comparison to other years. So does that mean the prices are going to crash and tumble? Again, of course, if the banking market falls apart or China invades Taiwan, things would change. But as we sit here right now, that doesn't seem to be where the market is. Another fascinating piece of information was presented by First American, their chief economist, Odetta Kushi. She shows the amount of increase of equity of homeowners. And take a look at the COVID period. Look what it did for the average homeowner. Their home equity went from $225,000 to $325,000, even with that correction. So it went up 50%. Now, prices may have gone up the same, but all that equity is sitting in their house and it's tax deferred. They only pay taxes if they sell it or if they don't trade it into something bigger. And so unlike other investments that are very volatile, housing still has been a good investment for those people who took advantage of those opportunities during the COVID period. Now, I live in California. If you wonder why things are so bad here, it's a combination of bad government and, I'm ashamed to admit, the California Association of Realtors seem to be in bed with the government. Now, I'm proud as a realtor. I think we do a lot of great things for our customers and for me as an agent to help me do my job. But politically, we're just part of the problem. And I'll just share with you an interesting press release that came out this week from the California Association of Realtors. Our governor, Gavin Newsom, issued his State of the State letter. They never go in person anymore. They issued a State of the State letter to the legislature. And so the California Association of Realtors responded to it by noting that the governor didn't even mention housing affordability or housing availability as a problem in California. So people are moving out of the state because they can't find housing and buy cheaper in Texas and Florida. The governor's not even paying attention. But what do the realtors say? The realtors say it's critical to support policies that create pathways to home ownership. What's a pathway to home ownership? Either you buy the house or you don't. What's the pathway? Now, if you want to say improve the economy and make pathways possible, okay, but really what they're ignoring, because they don't want to be politically incorrect, the problem in California is we haven't built enough houses. Building houses creates more inventory, more buyers can buy houses, keeps the price down, solves availability, solves affordability, also creates jobs for the people who are building houses and selling the houses. But even the California Association of Realtors has to pretend that there's some other problem. The problem is not whatever it is, it's pathways to ownership. Like, what, we're going to create a new dollar bill, a new bank account, a new loan for? Why don't we just build more houses so more people can buy houses? Doesn't that seem obvious? Or say you don't want to, and just admit it. You don't want more people, you want less people, and you're fine with them all being renters. If that's the case, just say that. But the California Association of Realtors, I think, is playing along with the politicians on that one, just not really being honest at all. Now, another bad article for the week, and this was the runner-up for the worst of the week, is from Redfin. And their headline says, which I found fascinating, the typical down payment has fallen 10% from a year ago as the housing market cools. Now, That sounds bad, right? The average down payments dropped 10%. Ooh, sounds like bad news. Well, but maybe it's not. Maybe it's good news. Maybe it's saying that people with less down payment are finding it available to buy houses because there's flexible mortgage products. That would be a good thing. But I think even more, though, what that means is if you look at the last couple of years, again, there's a common theme, but you had sellers who were selling their house, putting the whole money down in California, maybe selling for $1 million, and buying in Texas for $500,000 and pocketing the difference with, on average, larger down payments. That group has now done that more, and it's going back to more normal. I think the theme I want to get across is, for the last 2 years, we've had a lot of abnormalities. It takes time to work through the system, but take a look at this chart. The headline says the down payment dropped to 10%, but if you look at over time, the average down payment has been consistent from 2011 all the way through 2020 was about $30,000. And so maybe $40,000 is a normal market now, a normal down payment. But Redfin runs that as a headline. I'm not quite sure what the design of that is, what the purpose of that is. I'm sure there's one. But the worst article of the week, I think it's both just pathetic as well as shows you where they're at, is Zillow's press release. Buyers are in the game, but interest rates are keeping sellers on the bench. Now, I read that and thought, what the heck does that mean? How can buyers be in the game, but sellers are not? In every sale, there's two things. There's a buyer and a seller. If there's a buyer and no seller, that's not a sale. That's a buyer wanting to make an offer that the seller says no to. If there's a seller and no buyer, we call it inventory. Ultimately, the game is when buyers and sellers meet up, buy and close that transaction, that's a sale. And so interest rates are not keeping sellers on the bench. Some sellers aren't going to sell because they have a low interest rate now, and if they sell and buy a new house, the rate will go up in addition to the increased price, and they'll decide not to. But similarly, some home buyers may not buy because rates went up. But at the end of the day, the housing market is pretty flat overall. How can you possibly say the buyers are in the game, but sellers? This is not even a post by Zillow. This is a press release. What does that mean? They'll put it on their website. They release it so that other people run it. So they put it in their media room, and they put it on PR Newswire, and here Fox 21 runs it. Buyers in the game, but interest rates are keeping. I mean, really, all they're doing is parroting Zillow's article or running it. I guess they're allowed to. And you see other people down below. Here's Head Topics does the same thing. Here's DFW City Homes does the same thing. And so on Morningstar, you'll see these different organizations will run the same press release because they need something to fill, and Zillow's press release seems to fit the bill. But again, is this because Zillow's making some major research notice? Is there some real information here that somebody has to know? No, this is just their kind of feel that buyers are in the game, but sellers are on the bench. I say that, I can't even stop laughing. It's ridiculous. Here's what I want to say to you, that the news industry is not going to teach you anything. It's not going to educate you. It's not going to motivate you to do the right thing. You need to look at the data. And so what I would say is if you're looking to buy or sell, let's get you the data in your home. The numbers don't lie. And I think over and over again, if customers will call me about a property, I can show them what a home sold for in their area. Based on that, we can predict what the house is likely to sell for today if we move forward. If you're interested in buying or selling, let's get the actual data on your side rather than the guessing. And more importantly, it's never the right time to buy for the market and not you, or vice versa. It's the right time for you, and it's the right time for you to buy or sell. Let's have that discussion. If I can help, call me, text me, email me. I'm on social media at @BillGrossEXP. And as always, remember, make today your best day ever. Thank you so much.